My $5,000 experiment. Here's what a $5,000 dividend portfolio pays you monthly. From zero to dividend hero, the real story. What if I told you that a few years ago, I was just like most people, watching my hard-earned savings slowly lose value? Inflation, that invisible thief, was quietly chipping away at my $5,000. It felt like my money was stuck in quicksand, going nowhere fast. But then, I decided to do something about it. I decided to turn that $5,000 into a dividend income machine, a little money tree that would actually pay me every single month. Now, before you click away, thinking this is another one of those get-rich-quick videos, let me stop you right there. This isn't about theoretical numbers or fantasy portfolios. This is about real cash hitting my account, month after month, with all the ups, downs, and unexpected lessons I learned along the way. And trust me, it was nothing like what I expected. Before we dive in, if advertisements should interrupt this video, please do not click off of the advertisements. Please allow them to play through as a thank you to me for bringing you this valuable information. Now let's continue. Today, I'm pulling back the curtain to show you the raw, unedited truth of my 6-month journey when I just got started. Some months were amazing, some were, well, let's just say humbling. But here's the kicker, that roller coaster ride. It's completely normal. And once you understand why, you can build your own passive income stream that works for you. Part 1. The dividend dream versus reality check. Let's be brutally honest about something I wish someone had told me from day one. When you hear people talk about monthly dividend income, your mind probably pictures a steady stream of cash, like a gentle river flowing into your bank account every 4 weeks. Right. Wrong. Most dividend stocks pay quarterly. That means some months you get a nice chunk of change, like hitting the jackpot on a mini slot machine. Other months, crickets, or maybe just a few pennies. My average over these 6 months was a humble $8.79 per month. Yeah, I know. It sounds pretty pathetic when you say it out loud. But stick with me, because there's a much deeper story here, a story about long-term wealth building and the incredible power of patience. I kicked off this whole adventure out of sheer frustration. My savings account was earning me 50 cents a month on $5,000. That's like trying to fill a bathtub with an eyedropper. Meanwhile, everything else, groceries, gas, that extra latte, felt like it was getting a price hike every other day. I'd been devouring articles and watching videos about dividend investing and seeing people claim to make hundreds of dollars a month. So I thought, why not jump in and see what really happens when you start from absolute zero? Part 2. The core of consistent cash flow. What dividend investing really is. The first, and perhaps most crucial, lesson I learned is this. Dividend investing isn't a sprint to riches. It's a marathon, a deliberate, consistent strategy for building financial independence. While those high-flying growth stocks can swing wildly, up 20% one day, down 20% the next, like a roller coaster with no safety bar, dividend-paying companies are different. They're the steady oak trees in the investing forest. These are typically mature, stable companies with rock-solid cash flow that have been sharing their profits with shareholders for decades. Think about it. They're not trying to invent the next big thing. They're dominating their existing markets and simply rewarding their loyal investors. Some of these titans are even called dividend aristocrats, companies that have increased their dividend payments for 25 consecutive years or more. That means your income actually grows over time without you lifting a finger. It's like getting a raise every year automatically. And then there's the secret sauce, the unsung hero of compound growth, DRIP. No, not a leaky faucet. DRIP stands for Dividend Reinvestment Plans. Every time I received a dividend payment, big or small, it automatically bought more shares of that very same stock. More shares mean bigger dividends next time, which in turn buy even more shares. It's like a snowball rolling downhill, getting bigger and faster with every turn. This, my friends, turned out to be the absolute most important part of my entire strategy. It's the engine that powers wealth accumulation. Part 3. Building my $5,000 dividend machine. The 3 buckets. I decided to keep my initial approach simple, dividing my $5,000 into 3 distinct buckets, each serving a specific purpose in my quest for passive income. Bucket 1. The foundation, diversification with ETFs. My first bucket, the foundation of my investment portfolio, was all about broad diversification. I poured half my money into dividend ETFs. Think of these as super funds that hold hundreds, sometimes thousands, of dividend stocks under one umbrella. It's instant diversification, like buying a whole basket of different fruits instead of just one. I put $1,250 into SCHD, which stands for the Schwab U.S. Dividend Equity ETF. This fund focuses on high-quality U.S. dividend stocks with strong balance sheets, essentially vetting the companies for me. Then $1,000 went into VYM, the Vanguard High Dividend Yield Index Fund. This one targets high-yielding large companies, giving me exposure to those cash cows. These ETFs are my silent research assistants, doing all the heavy lifting and spreading my risk across a vast array of businesses. They are perfect for beginner investors. Bucket 2. Blue Chip Dividend Champions, the rock stars. My second bucket was dedicated to the true rock stars of the dividend world, the blue chip dividend champions. These are the household names, the companies that have been paying dividends for decades, weathering every economic storm imaginable. I allocated $500 to Johnson & Johnson, a healthcare giant that's been increasing its dividend payments for an astonishing 61 years. Talk about reliability. Another $400 went to Procter & Gamble, the company behind everything from your toothpaste to your laundry detergent. They've been paying dividends through every recession you can think of. Then, $300 each went to Coca-Cola, Warren Buffett's absolute favorite dividend stock with over 60 years of growth, PepsiCo, which owns everything from Pepsi to Frito-Lay, and those snack sales aren't slowing down. And Realty Income, oh. Now Realty Income is special because it actually pays its dividends monthly, 12 times a year, instead of quarterly. It's like getting a little mini paycheck every month. Bucket 3. Growth Dividend Payers, the Rising Stars. My final bucket was for the rising stars, the growth dividend payers. These companies might not pay huge dividends right now, but their payouts are growing at an impressive rate, like a sapling rapidly growing into a mighty tree. I invested $300 in Microsoft, a tech behemoth dominating cloud computing, an industry with explosive growth. Then $250 went into Apple, a company with a staggering $162 billion in cash reserves, aggressively growing its dividend income. And finally, $100 into Starbucks. Because, let's be honest, coffee addiction isn't going anywhere, and their global footprint is undeniable. Out of my $5,000, I actually invested $4,700, keeping a small $300 in cash. Why? To have some dry powder ready for future opportunities or market dips. That's a smart investment strategy for any investor. Then I waited. Part 4. The roller coaster of dividends, my month-by-month breakdown. And so, the experiment began. My first month, December, felt anticlimactic. Month 1, December, the initial trickle. My grand total for December. A whopping $1.75. That's it. Only Realty Income paid me because it's the only one that pays monthly. All the other dividend stocks pay quarterly, and since I bought everything late in December, I missed their payment dates. I'll be honest, I was a little deflated. But I reminded myself this was a long-term experiment, a journey, not a sprint. December total, $1.75. Month 2, January, a small step forward. January was better. I made $6.28. Procter & Gamble paid me $2.50, PepsiCo paid $2.30, and Realty Income delivered its consistent $1.75. I was starting to see the pattern of those quarterly payments slowly building. January total, $6.28. Month 3, February, the quiet before the storm. In February, Apple finally paid me $1.50, and Realty Income came through with its regular $1.75. It was a light month, and I started to realize that some months were just going to be quieter than others. February total, $3.25. Month 4, March, the dividend deluge. Then came March. Oh, glorious March. This was when most of the quarterly payers finally kicked in, and it felt like a dam burst. SCHD paid me $10.94. VYM paid $7.50. Johnson & Johnson paid $3.38. Microsoft paid 83 cents. Starbucks paid 38 cents. And of course, Realty Income gave me my usual $1.75. For the first time, I genuinely understood why people get so excited about dividend investing. This was the power of passive income in action. March total, $29.58. Month 5, April, another solid showing. April was another solid month. Procter & Gamble paid $2.50. PepsiCo paid $2.10. Coca-Cola finally paid me $2.25, and Realty Income stayed consistent at $1.75. Things were looking up. April total, $8.60. Month 6, May back to basics. Then May was back to a lighter month. Apple paid me another $1.50, and Realty Income gave me its reliable $1.75. May total, $3.25. Part 5. The Big Picture. What $52.71 taught me. After 6 months, my grand total was $52.71. That averages out to $8.79 per month. And yes, saying it out loud, it still sounds small. But here's the game-changing lesson I learned. That $52.71 covered my Netflix subscription for 6 months. Or my coffee habit. Or a few tanks of gas. It's not a fortune, but it's free money that required zero active work after the initial setup. And more importantly, it's growing. Remember that drip? Every single dividend payment buys more shares, which in turn generate even bigger dividends, which buy even more shares. It's like planting a tiny seed that slowly but surely grows into a mighty tree. This is the magic of compound interest applied to dividend growth investing. Part 6. Mastering the monthly flow. Strategies for consistent income. If you're like me and crave more consistent monthly payments, I discovered 2 powerful investment strategies to smooth out those income fluctuations. First, you can focus on monthly dividend payers like Realty Income, LTC Properties, or Stag Industrial. These are mostly REITs, real estate investment trusts, that are legally required to pay out a significant portion of their earnings as dividends, and many do it every single month instead of quarterly. Second, you can strategically stagger your quarterly payers. Most companies pay in specific quarters. By researching which months your chosen dividend stocks pay out, you can diversify across different payment schedules. This way, you can aim to have some payment hitting your account every month, instead of those big quarterly chunks. It's like building a financial symphony where different instruments play at different times, creating a continuous melody. Part 7. The future is compounding. My next steps. Here's where the real excitement begins, the power of compounding. If I never add another dollar to this dividend portfolio, and just let the dividends reinvest. The math is truly eye-opening. I'll get around $15 in total dividend income in year 1, over $150 annually by year 5, and over $250 annually by year 10. That's just the power of letting your money make more money. But I'm not stopping there. I'm adding $200 every single month to accelerate this growth, pouring gasoline on that compounding fire. I also learned some hard lessons along the way. Don't chase high yields. That 10% dividend stock often signals a company in deep trouble. High yields usually mean the stock price has crashed for a reason. Do your due diligence. Also, understand the payout schedule up front. Don't be surprised by those light months. My plan moving forward is clear. I'll continue to add $200 monthly, focusing on more SCHD and VYM during market dips for solid, diversified dividend growth. I'll increase my realty income position for that consistent monthly cash flow. I'm also looking to add Home Depot as another dividend aristocrat to my portfolio, and considering more monthly paying REITs for even smoother income. And yes, DRIP remains enabled on everything. That's where the true magic happens for long-term wealth building. Part 8. Start your own dividend machine today. So, if you're ready to start building your own dividend income machine, to stop letting inflation eat your savings, here's what I recommend based on my journey. Start with what you can afford. Even $1,000 can work with this same strategy. Just scale the amounts proportionally. The important thing is to start. Pick 1 or 2 solid stocks from each category initially. You don't need to buy everything at once. Focus on quality dividend-paying companies and ETFs. Set up automatic dividend reinvestment, DRIP. I cannot stress this enough. This is where the power of compound growth truly kicks in and your investment portfolio blossoms. Be patient. This isn't a get-rich-quick scheme. This is get-rich slowly. A proven investment strategy that actually works. Understand the payment reality. Most months won't be huge, and that's completely normal and expected. It's the long game that matters for financial freedom. My $5,000 portfolio averaged $8.79 monthly. But remember, the potential for passive income and wealth creation is immense. This is how everyday people build financial security for their future. If you found this video helpful, hit that like button. It really helps the channel. And subscribe to join our community of smart investors on the journey to financial independence. What are your thoughts on dividend investing? Let me know in the comments below. I read every single one. Until next time,